Welcome to Annamalai University, Directorate of Distance Education, Management Discipline, teaching on financial management, which is one of the critical function of business organization, especially in terms of proposing, planning and expediting, monitoring and auditing. One of the most important feeding of cash, credit and supporting in all the other functional areas of various projects and activities. Finance is the most important thing. So the subject, people show interest in financial management from the perspective of resources. At the same time, the tools and techniques used to assess the financial management is more interesting and very important for running the operations of the company. So with this briefing about financial management of a company, let's learn the subject by understanding first the learning objectives and the learning outcome. The learning objectives predominantly on finance and its concern with every other functions. That's what I briefed in the beginning. When you say marketing, when you say HR, when you say production, when you say systems, all that are requiring gadgets, raw materials and machineries, which has to be planned and purchased and provided only through financial sanctions of the finance department. And therefore, financial, all aspects of transactions, inflow and outflow of cash, credit and debit of all transactions are recorded, documented, compiled, preserved and audited. So in that perspective, financial management is one of the most important function in the organization. Financial planning and forecasting is the second most objective, and sources of finance, dividend policy and capital structure, all these need to be studied in order to implement and act on financial management function. The learning outcomes are financial environment, what's happening around the company internally and externally, where the transactions are recorded, transactions are planned and how the banking support is provided and how the other credit facilities are available, other sources of financing are available to the firm. So taking into account the internal as well as external aspect of financial transaction would be the most important ability or the skill set required for a finance manager. And the second one is about functions of capital market, how the capital market is supporting all the public sector, private sector enterprises in terms of investments and market capitalization, how the investment of public person and by the company gets added in value into the process of marketing and all transactions, how the investments become more attractive market capitalization. So that's the function of capital market. And investment decisions, how company can take decision in investing their own wealth into the operations of the company, and how individuals can invest their money and how companies can attract in the form of shares and debentures and other deposits, how companies can mobilize their or procure their cash into the operations of the company. And then you have financial resources allocation, how much should be planned in the budget and how much can be allocated for the operations of the company. And last but not the least is cost of capital, how much money you spend it to mobilize the capital for the operations of the company, whether it is working capital or in any form. And dividend, how much it will be the payout for the shareholders, earnings per share, how much could be allotted as a dividend for the investors. So that could again be an important decision in the learning outcome of this course. Now the planned structure of the syllabus goes into 6 units. First unit is about finance functions, or let us say introduction to financial management, and the second unit is about short term finance, third is about long term finance, fourth is dividend, fifth is cost of capital and capital structure, and the sixth unit is about merger and acquisition. Now the first unit is about finance function. We will be devoting this presentation and this teaching session on the first unit, which is about finance functions. Let us say first lesson is about overview of financial management, second lesson is about the time value of money, third lesson would be of short term financing, fourth would be of working capital management. The first lesson contents are about evolution of finance as a discipline, definition of financial management, goals of financial management, and how the wealth maximization and profit maximization can be compared and discussed and focused, and then decisions of financial manager, and you have functions of manager, and there are more important two different major managers. One is about controller and the other one is about treasurer, how the controller and treasurer work together and how they deliver their task in the support of the financial management function. And you have risk and return trade-off, how the how much you take risk to earn more profit. The higher the risk, the higher the return. So how this trade-off can be done in the financial management as a course. And we have definitions of financial management. There are quite interesting definitions for financial management. Let us see the provisions of money at the time it is wanted. That was the preliminary definition for financial management. Financial management takes care of provision of money at the time it is wanted. And then the second definition goes like this: procurement of funds and their effective use and efficient use of capital funds. It is not that only mobilize the capital, but how efficiently we use the capital funds, and arrangement of cash and credit. That is the easiest and simple definition of financial management, arranging cash and credit facility in the firm, and acquisition and financing of long term and short term credits for the firm, how the company can acquire funds and from the long term sources as well as from the short term sources, and effective utilization of funds for efficient operation. That is again another interesting definition. Then judicious use of capital. Capital should be used in very careful and more efficient way. There should be a care in spending the capital in right perspective. And then the final definition would be of PODC, which is planning, organizing, directing and control of financial resources of optimum utilization and protection of insurance against loss. So here we see how the financial resources are used in an optimal way and how the care is taken to protect the insurance against the loss. So these definitions will give you an understanding about various ways in which a company can plan, organize the sources and direct, allocate the funds and then control the spending also. So from that perspective, even if there is a loss, company should insure so that the loss is minimized. So the investment decisions, if you see the most prominent investment decisions are two-sided. One is about how companies are taking decision internally, and how companies are taking decisions externally. So if you see risk and returns in the planning of or framing the fixed and current assets of the management policy, and forecasting and controlling the cash flow requirement, etc. In the external financing, you see the debt and equity ratio has to be maintained, and financing decisions has to be carefully done. Planning for a balanced capital structure is more important if you look at the external financing aspects, and deciding upon the requirement and sources of new external financing, carrying on the negotiations for new outside financing. You have to have a negotiation platform, therefore the financial cost of capital is minimized and debt equity ratio has to be maintained. On the other side, internally you should also take decisions, which again the dividend decision, how much you give it to the shareholders, investors, that's again internal decision, and the determination of the quantum and timing of the dividend payment, when you should pay the dividend to the investors, and determining the allocation of the profit, how the profit can be allocated, and checking the performance of the company and financial performance of the every other activities. In other words, in the external we see debt and equity ratio, whereas in the internal financing we see the payout ratios, how much you pay to the investors, and both come together in minimizing the cost of capital, how much you can seize down or bring it down the finance or the capital mobilized. So financial management decisions normally into the decisions on the investment, decisions on the dividend, and sourcing the finance. From all this perspective, let us see there is a very straight relationship between finance functions, whether it is internal or external in terms of risk and returns. Overview of financial management. Let us see the ultimate platform is on one side how much risk you take, and on the other side how much return it gives it. So ultimately we end up in the final stage of how much is the market value of the company. So that we call it as market capitalization. So risk and return trade-off will give you, based on all your decisions, it will give you the market value at the end of the day. When you come to the financial management as an overview, the financial management leads to maximization of the share value. A person may be buying a share at 10 rupees initially in the offering stage, but later the value of the share based on the market acceptance and the market performance, the share value will go for a premium. So that is the ultimate aim of the financial management function. So, and that leads to important financial decisions, namely investment decision, liquidity management, financing decisions, and dividend decisions. So if you see, the financial decisions are most important in both perspective, and there will always be a trade-off between the investment and the dividend. Now the lesson 2 is all about time value of money. How the money that is invested today, or the money that you have it today, is it worth high or low? If you go for predicting the time value of money or net present value, there will always be a decision whether you can foresee the future value of the money that can be drawn or paid in the initial stage, but there will be a component of annuity which is involved. So let us see the reasons for time value of preference for money. People normally see the uncertainty of loss. So, while taking risk, people see there is an uncertainty of loss, and therefore they will see the time value of money. If I take the money today, I am much safer. If I take the risk and go further, the time value of money in the future may be at the higher side. So, the significant aspect is taking risk and seeing the loss, and then satisfying the present need. So, I am happy with what I have, and from that perspective decision can be made on the time value of money. Similarly, you have investment opportunity. If you have more opportunities, very attractive opportunities, you can think of whether you keep your money with you at the present value, or if you are looking for the future value. And the concepts involved here is book value of money, market value of money, liquidation value of money, replacement value, going concern value, and bonds value. So, these are different concepts by which you look at the time value of money. And you have valuation concepts. So, the valuation concepts, there are major two important concepts. One is about valuation done by compound valuation, or otherwise we will say compound interest, simple interest and compound interest. That is the basic underlying concept. Here we see compound interest. For suppose if you are keeping the money for 3 years, and company is ready to pay, or the bank is ready to pay compounded interest for 3 years at 10% rate. Every year you will have the 10% interest, and principal and interest will be made available. So, if suppose investing 1000 rupees and 10% of 1000 rupees is about 100 rupees. So, 1100 rupees you will be having at the end of the year. So, that 1100 rupees will be taken into consideration as principal, and then 10% of the compound interest rate will be applied, and therefore you will have 110 rupees as interest for the second year, and then you will have 1110 rupees or 1110 rupees will be available to you. So, likewise you keep adding, the first year value is 1100 rupees and you have 110 rupees added, and therefore you will have in the second year 1210. Likewise, in the third year 1331 rupees will be available if you apply the compound interest for the valuation. So, likewise you have compounding of interest over a period of number of years. So, there is a simple formula to calculate the amount at the end of the period of n is equal to a simple formula. It is a compound interest formula, which is P within bracket 1 plus I. So, where we take principal out from the equation, or otherwise P plus we can say. So, the formula is P within bracket 1 plus I to the power of n. So, if you apply this formula, you will get the same value for the 3 years. If you apply 10% for 1000 rupees, you will get the same value of 1331. And again you can do it multiple compounding periods. So, here what we do, the compound interest is calculated in a periodic manner. In this particular calculation, if you see semi compounding, which means every half year period compounding will be done. So, in a year you will get 2 compounding periods. So, that way the number of compounding years can be done. So, whether in a given year, how many times quarterly or semi half yearly or semi annually, how do you do it? So, that formula is, the amount after a period is equal to P within bracket 1 plus I by interest by the number of times per year compounding is made, close the bracket, m into n. So, using this formula we will be able to find out how many times the compounding interest is done in a year. So, that way this formula can help you to find out the compounding interest. So, this will give you, there is a reference table available for every year for a given compounding interest rate. That factor value is established, and that factor value is ready made available to you. If you apply this factor value, you will be able to calculate how much is the amount of interest could be paid. So, in this illustration, you see Mr. Investor invest rupees 500, rupees 1000 and 2000 at the end of each year. Calculate the compound value at the end of 3 years compounded annually when interest is charged at 10%. So, first year he is investing 500 rupees, second year he is depositing about 1000 rupees, third year he is depositing about 2000 rupees. So, by taking into account number of years compounded, if you see for 500 rupees 2 years compound is available, for 1000 rupees only 1 year is available, for 2000 rupees there is no period of compounding is available. So, if you take that factors for 2 year period, for that is 1.210, for 1 year period it is about 1, and for 0 it is 1. And likewise, if you multiply these factor and the interest rate, you will get 605 for the first year, 1100 for second year, and third year it will about 2000 rupees of your own, and therefore you will get 3705. So, you can also calculate how the investments are done and the compounding interest rates are done. Similarly, you can do it for another illustration which is given. Find the compound value of annuity when the 3 equal yearly payments of 2000 are deposited into an account that yield 7% compounded. Now, you see the solution. 2000 rupees you are investing, the factor value at the 7% rate for 3 years is 3.215, and you will get 6430. Present value of money after n years. Now, the present value of money after n year is, you will be able to understand what is called annuity. Annuity is quite opposite of or inverse of what do we call it as compound interest rate. If you see the compound interest rate formula and the annuity formula is reverse or inverse of the compound formula. So, here the principal amount the investor is willing to forego at present is equal to the amount at the end of the period n divided by 1 plus I to the power of n. So, this is a reverse of compounding formula. Now, coming to the annuity, present value of the annuity and the compounding value, here you see the value, what is net present value, what you see today in the terms of annuity. In the practice, people would like to appreciate and enjoy their annuity value if they do not want to take much of risk. If they want to take a little bit more of risk, they will go with compound interest rate. So, if you see here, the calculating the present value of the annuity of 500 received annually for 4 years when discounting factor is 10%. So, you would like to have 500 rupees every year. So, what will happen? Year 1, 2, 3, 4, for every year you would like to have 500 rupees. The present value of that 500 rupees is 454.50. So, the present value of that money is only 454.5. When it comes to second year, the present value factor is 0.827, therefore, you will get only 413.5. Likewise, for third year and fourth year, you will see at the end of the year 585 rupees you will get. So, the basic means of adding up the present value factor and multiplying with 500 rupees, you will get this 1585. It depends on the interest of the person. So, likewise, you have the perpetual annuity of the present value, and the present value of the perpetuity of an amount can be ascertained by simply dividing the amount at the end of the year by interest rate as discount, symbolically represented as A by I. Let us see, Mr. Principal wishes to institute a scholarship of 500 rupees for an outstanding students every year. Normally, we call it as endowment. So, he wants to know the present value of the investment which would be yield 500 rupees in the perpetuity discount at 10%. Solution would be the present value can be simply calculated by dividing 500 rupees by the interest rate. 10% means 0.1. That gives you the value of 5,000. So this is quite convincing, since an initial sum of 500 rupees would, if invested at a rate of 10%, would provide a constant return of 500 rupees for ever without any loss of initial capital. Now coming to the third lesson, it's about short-term financing. The measure is to maintain short-term financing and characteristics of short-term financing, nature of credit, sources of short-term financing and advantages of short-term financing. So there are credits available, and you see public credit, who all can support the short-term financing: public credit, capital credit, mercantile credit, personal credit, banking credit, investment credit, commercial and consumptive credits. And now the sources of short term are trade credit, bank financing of receivables and factoring. And the fourth lesson would be of working capital management, and working capital management is providing the support for current asset and current liability. How many concepts are available to explain the phenomena of working capital, and what are the classifications of working capital, assessment of working capital, how do we assess, and problems of inadequacy of working capital, reasons for inadequacy of working capital, excessive working capital, principles of working capital management, steps involved in effective management of working capital, sources of working capital finance, working capital forecasting techniques, working capital financing policy. Now the predominant component of working capital management is, one is on the current assets and the other one is current liabilities. Current assets include inventories, raw material, work in progress, finished goods and stores. This is the major important element of current asset, and the other one is sundry debtors, third one is about cash and bank balance, and the last one is about loans and advances. Current liability includes sundry creditors, unclaimed dividend warrants, unclaimed debentures interest warrants, short term loans and advances, provision of tax, provision of dividend. If you see on the current liability side, how much money should go out from the company, whereas the current asset is about how much money that you bring in or cash that you bring in from other agencies to make the current assets available in the company. So there are working capital types, permanent and temporary working capital, and you have different sub-classification of the permanent working capital as well as the temporary working capital, and you have the pattern of working capital, how much is fixed and how much is varying in nature. So in that perspective, if a company is growing, you see the both fixed and varying component of working capital will be in the progressing side. And principles of working capital are principles of risk variation, principles of equity position, principles of cost of capital, principles of maturity of payment, principles of negotiation. It's very, very important when it managing the finance. Sources of working capital, you see the short term or long term sources and the medium and short term sources. So you can visualize how the company long term sources can be brought in, and similarly how the short term and medium term can be brought in. So if you see internal aspect of medium and short term sources, probably internally depreciation of the machineries, reserves and provisions, inter-corporate loans and deposits, and you have trade credits, bank credit, public deposits and customers advance, factoring, all these are forming part of the short term this thing. And you have working capital forecasting. We have a unique pattern of the working capital cycle. Now three methods are available. One is basically the percent of sales, how much percent of sales can be given, and the second one is regression analysis. Third one is about working capital cycle, and the cycle you can see here how the cash taking various stages from the raw material or inventory in the raw material or and the work in progress, and when it comes into the finished product and how it comes into the stores, and then again coming back to once the accounts receivable come into the company, and then it takes the shape of cash. So transformation of cash into various stages is, we call it as working capital cycle. And you see here the inventories are the major component, 3 different inventories, probably you can say raw material inventory, semi-finished inventory and finished inventory, and then once it is realized, sales is realized, account receivable could be done. So by doing this working capital forecasting, compute the duration of the operating cycle and calculating the number of operating cycles in a given operating period, and estimating the total amount of annual operating expenses, ascertain the total working capital requirements. Keeping these steps, we can predict the working capital in the future. So in summary, we have done the session on overview of financial management. In other words, functions of financial management, how the definition of financial management and how people are making ready cash and credit for the purpose of operating the various functional areas of the company, and what all the functions that other functions of organization can be related or closely associated, and how the finance manager can take necessary control as a controller of finance, and also on the other side treasurer providing cash to the various operations of the company. So differentiating the controller's function as well as treasurer function would be of greater importance. And coming to the sources of finance, short term sources we have discussed about how important the sources of short term can be mobilized from bank, public and various forms in which the deposit can be mobilized and which can be fed into the company, and keeping the whole component, how much the company is encouraging investment and how this investment becomes most attractive market value, and therefore you pay dividend to the investors. So end of the day, financial management takes care of how much profit that you make and how much wealth that you create in a company. So we may be in the next session looking out what all the components of short term financing and how the short term financing can be addressed. Thank you very much.